Welcome to the WTR Small-Cap Spotlight Flashcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's Flashcast episode, I'm being joined by my colleague and WTR Senior Energy and Sustainability Analyst, Peter Gastreich, to discuss his initiation of coverage report on Neste Corporation. Neste is listed on the OMX Nordic Exchange with ticker symbol NESTE. The company's U.S. unsponsored ADR OTC ticker is NTOIY. Neste is a Finland-based company with worldwide operations in renewable fuels and oil products. Originally a traditional oil refiner in Finland, the company was an early adopter of renewable fuels and now produces and markets its products on 3 continents. On today's call, Peter will also be framing the broader market for renewable fuels. Good morning, Peter, and thanks for joining us.
Morning, Tim. It's great to be here.
Peter, could we kick things off with you summarizing the top 3 to 4 key takeaways from your Neste initiation of coverage report, please?
Yes, Tim, absolutely. Well, number one, Neste now runs the world's largest platform for renewable fuels, including renewable diesel, sustainable aviation fuel, and other products in Europe, Asia, and in the US. The focus is mostly on the transportation industry, and Neste has notably large customers, DHL being one of them. Furthermore, all of its customers are at a very early stage in their decarbonization plans. Water Tower Research has covered renewable fuels extensively, and our view is that we are in the very early stages of a multi-decade growth opportunity in this area. For example, current SAF production meets only about 0.5% of global fossil jet fuel demand, so we have a very, very long runway here for production to fill that remaining gap, and that is the market that Neste and many other companies we have been covering and speaking with here at WTR are after. The second thing to point out from the report is Neste's multiple competitive advantages. The global footprint and benefit of scale and logistics is certainly a part of that, as are its strong capabilities in feedstock collection and pretreatment, which is very critical in this business. Another competitive advantage versus other renewable fuels producers is that Neste still does operate a traditional and complex oil refining and marketing business, so that diversifies its risk and provides additional cash flow. The third key takeaway from the report would be the operational outlook. Like most renewable fuels producers, Neste's operations have come under severe pressure. Renewable fuels are now facing oversupply, high feedstock costs, and policy uncertainty, and that's well reflected in the consensus analyst estimates for continued weakness this year. However, as visibility on the renewable fuels market starts to improve later this year and into 2026, and with the company's expansion project by 2027, the prospects will start to look more evident. Also to add, with Neste's operations near break-even, the company's significant planned cost cuts should be supportive. So bottom line, while Neste is by no means out of the woods today, it does look like the worst is behind and the company is setting the stage for a recovery.
That's a great overview, Peter. Let's next have you elaborate on the company's strategy, please.
Well, given the ongoing tough market conditions, Neste has adjusted its strategy, and this came with a new CEO who took the helm late last year and has been very clear in terms of laying out the company's strategy. Overall, the company is prioritizing maintenance and efficiency investments over new growth projects in the near term and will prepare for its next wave of growth more in the 2027 to 28 timeframe. The company's introduced a performance improvement plan aimed at cutting costs, improving cash flow, and limiting further weakening of the company's balance sheet. Within that, Neste plans to improve cost competitiveness and has implemented a plan to drive 350 million euros in annualized run rate EBITDA improvements. In terms of production growth, Neste expects to deliver about a 10% CAGR in renewable fuels through to 2029. Now, turning back to the balance sheet, management are targeting to keep the leverage ratio to under 40%. Something to consider here is that just a few years ago, Neste had a net cash balance sheet. Finally, while the company is easing its growth capex in the near term, it's very clear that it will continue investing in technology and innovation. This will be critical to stay ahead of the competition. For example, we are of the view that Neste's HEFA process, which refines vegetable oils, waste oils, or fats into SAF, will come into feedstock constraints after 2030. So Neste may need to prepare for other pathways to sustain its growth outlook.
Peter, we can't really talk about biofuels without asking about the broader policy environment. I'm sure our audience would be interested in your views here and to the extent which this affects Neste. It also strikes me that the company has a lot to navigate given that it's operating in multiple geographies.
Yeah, a lot to navigate for sure, Tim. I'll start with the U.S., where Neste has a renewable fuels JV with Marathon Petroleum in California. There is little doubt of support on the state and local level where the JV operates. It's more the federal level that the market is focused on. That said, in the U.S., we see evidence of a lot of bipartisan support in Washington, D.C. for homegrown biofuels as being beneficial for the rural economy and energy security. President Trump's National Energy Emergency Executive Order is not focused on fossil fuels alone. This is an all of the above strategy. It lists biofuels, including specifically aviation fuel, alongside natural gas liquids, and other fuels. So I think this will eventually come around to looking supportive for domestic biofuel producers, and that includes Neste's JV with Marathon. Now, with respect to tariffs, something Neste's CEO flagged at the first quarter results briefing was that the company's global platform should help to defend against a major negative impact. First, most oil products are exempt. Second, Singapore has a free trade agreement with the US that should be a benefit for Neste's renewable fuels facility that's operating there and exporting both to the US and to Europe. Now, for US operations, that's the Marathon Martinez JV, used cooking oil or UCO imported from China is subject to tariffs. But also, as we know, this U.S.-China situation is very fluid. In any case, it could mean that Neste would need to look at domestic U.S. sources, for feedstock. Now, for the EU, I don't think that the region is going to waver much in terms of the end goals of decarbonization. The uncertainty is more about the path to getting there and at what pace we see mandated levels coming in. I think if we learned anything about the current situation with renewable fuels, it's that voluntary demand is not going to be the market savior that investors thought it would be, even in Europe. So mandates are important. Now, the Refuel EU regulation started this year with 2% mandated SAF blend, and that's EU and UK, and has substantial increases that come into effect every 5-year increments. Now, it would help everyone, both producers and investors alike, if those increments were not every 5 years, but instead were adjusted to more of an annual basis. Because again, we can't depend on the market voluntary demand coming through before those mandated levels kick in. I'll point here to what our WTR CEO and co-founder Sean Severson likes to say, and it rings very true here, and that's that companies are no longer chasing green for green's sake, unless it's going to make green, as in dollars and profits.
I love that line. Are you able to illustrate the financial impact of these various drivers to Neste, Peter?
Sure. Neste has experienced substantial decline in performance last year, and after having very strong years in 2022 and 23. We saw a decline in the oil products business, but that really came back to more of a normalized level, and that was following some increased refining capacities in places like Nigeria. The renewable products division, meanwhile, booked a loss for the first time in more than a decade, and that was impacted by oversupply, reduced renewable credit values in the US, lower spot premiums in Europe, and operational disruptions. Coupling the deterioration in operations with heavy capital expenditure and growth initiatives led to a weakened balance sheet, with the net debt to equity rising to 56% by 2024. This is quite a contrast from net cash just a few years earlier, and that sparked management's performance improvement strategy that I mentioned earlier. Now, in terms of outlook from here, I sort of mentioned this toward the beginning, but the earnings are expected to continue to look weak this year. We're going to see a gradual recovery in the years thereafter. The growth the next few years should be supported by cost cuts, the Rotterdam expansion, and improved visibility on the global renewable fuels market.
As we prepare to conclude today's Flashcast, Peter, is there any other WTR research content you suggest investors focus on in this renewable fuels space that will help them get their arms around the space even better?
Yeah, absolutely. We've been generating a lot of thought-leading content on renewable fuels. One area we are watching very closely is in the ethanol carbon capture space, and that is in part due to the positive implications for U.S. homegrown sustainable aviation fuel. We published a report in February asking what carbon capture and storage, or CCS, could mean for U.S. ethanol and SAF, And then following that, we hosted a related symposium in April. It looks very interesting now with carbon capture figuring prominently in President Trump's recent Earth Day statement. The contribution to U.S. energy abundance and the key role that CCS ethanol can play in supporting farmers, rural communities, and the U.S. agricultural economy is hard to deny. So it's worth investors to start thinking about these things today and be positioned for when we see the air clear on these policy risks. We at WTR are here to help with that due diligence process. And also, Tim, I'd like to flag that outside of our leading written research, we've been hosting numerous podcasts, symposiums, and fireside chats with senior management of innovative and leading industry trailblazers in the renewable fuel space like Gevo, Green Plains, LanzaTech, Rex American Resources, Sky Quarry, Sonato Bio, and there will be many more to come. So please stay tuned.
That's great. Thank you for those insights surrounding your initiation of coverage report on Neste, Peter Gastreich. Also, a special thanks to the producer and editor of the podcast, my WTR colleague, Joe Brunetto. Thank you for listening. Don't forget to subscribe, as well as visiting www.watertower Research to read the report Peter just referenced, as well as countless other small cap equity research reports, podcasts, fireside chats, and conference schedules from Water Tower Research. We will see you the next time for another Small Cap Spotlight podcast and Flashcast as well.